Hello viewers, in this video we will be diving deeper into intermarket analysis essentials. Typically, understanding this concept is key for both traders and investors. As such, it's important to stick around so as to know or to learn what to focus on when you are performing your intermarket analysis. Intermarket analysis involves the analysis of more than one related class of assets, including stocks, bonds, commodities, and currencies, among others. The analysis is usually done to help determine the strength or weakness of the asset classes that one is considering to trade. The concept was first introduced by John Murphy, a financial market analyst, in his book Trading with Intermarket Analysis. He outlines that traders can benefit from looking at relationships between different classes of assets. Typically, intermarket analysis can help investors identify the stage of investing cycle along with best performing and worst performing asset classes. At the same time, you have to mention that one of the principal points to note is that intermarket analysis involves looking at asset classes or financial markets that have strong correlations. For instance, when one is analyzing the US stock market, that investor can look at related markets such as the US dollar commodity market or commodity prices and the bond market. Typically, commodity prices often have a direct effect on the US stock market. As such, analysis on commodities and stocks together may be used to help predict the future direction of the stock market or the future direction of the US stock market. Analyzing the intermarket relationship between two or more variables is usually possible with available data, chart comparisons, and spreadsheets. Typically, most traders and investors use correlations to analyze the intermarket relationship between one variable and another in a different dataset. Usually, the degree of correlation between the variables indicates the strength of the relationship. At the same time, we have to mention that a positive or a correlation study of two variables can either yield a positive or a negative correlation. Positive correlation means that two variables tend to move in the same direction. The correlation reading can read as high as positive 1.0, which would be perfect positive correlation. In investing world, those would mean that two assets or two asset classes move in the same direction. Obviously, such correlation or perfect correlations are often very rare. Any reading between plus 0.7 to positive 1.0 sustained for a long period of time indicates that two variables are statistically significant to each other. Identifying such relationships through intermarket analysis can be very helpful to both investors and traders when making their trading decisions. On the other hand, a negative correlation, which is also known as inverse correlation, shows a negative relationship between two variables or two asset classes. Negative correlation values can go as low as negative 1.0. You have to mention that a sustained correlation between negative 0.7 to negative 1.0 usually indicate a statistically significant relationship between the two asset classes. With the negative correlations, it's important to keep in mind that the variables will move inversely to one another. That means that when one asset class is moving upwards or one variable is moving upwards, the other variable is moving downwards. When the relationship is close to zero, it indicates that the relationship between the two variables is weak. If the relationship moves from positive to negative, it shows that the relationship between the two variables is unstable and cannot be relied on to provide trading direction or to make trading decisions. Essentially, there is no reliable correlation between the variables, meaning that the variables cannot be used to determine the direction that will be taken by the other asset class when the comparing asset class takes a certain direction. Two of the main factors influencing intermarket analysis and relationship are inflationary and deflationary forces. The most clearly defined intermarket relationship affected by inflation or deflation includes bonds and commodities, stocks and bonds, and commodities and the US dollar. Typically, in an inflationary environment, there is usually a positive correlation between stocks and bonds. When the value of one asset rises, the other asset follows suit. Typically, bonds change direction before stocks. So, a reversal in the direction of bond prices may indicate that stocks or that the stock prices may change trend in the near future or in the coming future. Further, during inflation, there is typically an inverse relationship between the US dollar and the commodities and between bonds and the commodities. When one asset class rises in price, the other asset class declines, hence an inverse relationship. On the other hand, in a deflationary environment, there is usually an inverse relationship between stock prices and bond prices. It's important to note that this translates to a positive correlation between stock prices and interest rates. Also, we have to mention that there is an inverse relationship between the US dollar and commodity prices, as well as between bonds and commodities. This presents the same scenario as was the case with an inflationary environment. Sorry. The only positive correlation in inflationary environment is between stock prices and commodity prices. As such, it is important to take note of such relationships and such dynamics that usually happen when you are performing intermarket analysis. It is imperative to point out that intermarket analysis can provide an insight into the future direction of financial market, as we have seen. As such, determining the correlations between various kinds of asset classes can provide important confirmations into the probable direction of the asset in consideration or the asset that a trader or an investor is intending to take a position in. For instance, relationships between certain stocks can provide insights into when a new trend is about to begin or when it has just begun. As such, this can help investors and traders in either exiting existing positions or taking new positions or entering new positions with an intent to make profit as the trend changes. As we have always mentioned, it is important for traders and investors to note that there is no method of analysis that is designed to be used as the only method of analyzing assets. It follows that intermarket analysis is most effectively used along with other analytical tools or techniques. Also, traders and investors have to keep in mind that correlations revealed through intermarket analysis are not guaranteed to remain stable. As we have seen, there are instances where correlations can change. Typically, changing economic conditions may lead to changing correlations. Positive correlations between asset classes may become negative correlations, or correlation may cease to exist altogether. Thank you for watching. We hope that you have learned something about, or you have realized the significance of having an understanding on the concept of intermarket analysis, what to look into when you're taking your positions, and how to factor in such correlations before taking the positions. We will interact again in our next trending video. Thank you.